Okay, good afternoon and welcome back everyone to our Beginners Options Master course. This is our second course that we're starting in 2020. And this builds on the first course that we launched here last month, where we discussed many of the basics of options trading, talked about call and put options, what they are, the differences between buying and selling call options and put options. And then we did that market overview session where we went over the current market conditions, looked at some of the symbols together, and showed you at a very basic level how to utilize options to play different types of bullish and bearish scenarios. And we discussed a little bit regarding the different nuances between what it means to buy a call versus sell a put for bullish strategies, and buy a put versus selling a call for bearish strategies. For those of you that are joining us for the first time here today, welcome. I do recommend that if you're beginning to learn how to trade options, or if you're just starting out with the trade options, to make sure that you watch those recordings so that you have a better understanding of the basics. And the course that we're about to embark on today is really designed to build on that and to show you real strategies that you can deploy in your own portfolio, utilizing the basic strategies that we discussed in the first course. So today we're going to be talking about I would say the most critical option strategy that any equity investor should have in their portfolio, which is how to utilize options to enhance your stock and ETF positions. So before I get started, can everyone please pull up your chat window at the bottom of your screen? And I just want to get a quick sense here. How many of you here, there's over 100 of you here on this educational session. How many of you trade stocks or ETFs? If you trade stocks or ETFs, please type stocks or ETFs into the chat window. And if you don't trade stocks or ETFs, just type no, just so I can get a quick sense for the audience here in the room. So far I see a ton of stocks and ETFs. I see a couple of no's. Looks like 5 or 6 no's, but predominantly almost all stock or ETFs. So today what we're going to be talking about is are the option strategies that are useful for your stock and ETF positions. So and usually we don't think of options as a strategy to help our stock positions, because we think of options as its own asset class that lets us leverage our capital and take directional views with limited risk. A lot of people can think of options as kind of this tool that allows you to trade, highly leveraged products. And yes, you absolutely can use options for those strategies, and that's actually what we're going to cover in part 2 of this course. But today what we're going to do is we're going to talk about how to sell options, sell call options, and sell put options, and how they can be used to enhance your equity positions, your stock and ETF positions, because they can actually be utilized to allow you to buy your stocks at a discount. So imagine purchasing stocks at a discount, and then more importantly, showing you how to sell those stocks eventually after you purchase them, hopefully at a higher price for a profit. And the 2 strategies we're going to cover here today are cover calls and cash secured puts. So before we get started here, I'm just going to have a quick disclaimer. What we're going to discuss here is purely for demonstration and education purposes. It is not a recommendation or solicitation to buy or sell any specific securities. And before I get started, I just want to do a quick poll here. I just want to get a sense for what is the audience, what is your experience level with options trading? Are you new to options trading? Do you have some experience, or are you already an experienced options trader? Okay, so far I see almost half of you say that you're just learning how to trade options, about 40% of you. 50% of you say you have some experience trading options, and about 10% of you say that you're an experienced options trader. Okay, great. So that gives us a sense for the audience here in the room. So for those of you that are brand new to options trading, welcome. This course is designed to give you a practical understanding of how options can be utilized in your portfolio, and then show you the tools and resources that we have built to help you implement these strategies for your own portfolio. For those of you that have experience trading, this is hopefully a refresher for you to understand the benefit of these strategies, and also teaching you what are the optimal option strategies to utilize. And for those of you that are experienced options trading, I know there's just a few of you in here, but for those of you that are experienced in options trading, I really hope that you're able to take away from this educational event to tell you a little bit about what are the best ways to utilize options for your portfolio. So let's go ahead and get started here. So that's the poll here. As you can see, actually the largest group here are people who are looking to learn. So welcome. So for those of you that are looking to learn, especially for those of you that are brand new, I highly recommend you to register for an OptionsPlay account, which is again available to everyone free of charge. You can use the link that I just posted into the chat window if you have not already signed up for this. This gives you access to the free OptionsPlay platform, which is one of the tools that I'll be showing you here today. Access to bi-weekly options education webinars, just like the one you're on here today, and a free on-demand options video library so that you can view some of the previous courses. So I talked about a previous course that we just finished in the month of March. I recommend for those of you that are new to options trading, since half of you say you're new, to review that first course before you continue on with this course that we're currently in, which is more of a practical and implementation course to show you what strategies can you actually implement in your portfolio. And access to weekly cover call and short put reports, which are going to be directly related to what we're going to teach you here today. This is all available to you free of charge, courtesy of the Montreal Exchange. You just have to register using this link on your on your page. And thank you, Preet, saying, I've been learning a lot through your YouTube videos, but I'm having a hard time getting options unlocked in my trading platform. So for those of you, that actually brings up my second question here. I wanted to ask users, how many of you actually have, since so many of you are new to options trading, how many of you have an options trading account? How many of you do not have an options trading account? And how many of you are not sure whether or not you have an options account? Okay, so it seems like most of you do, right? About 80% of you say that you have an options account. 20% of you say you do not have an options trading account. So for those of you that have answered that you do not have an options account, you definitely want to contact your broker and understand what is the process that is going to take for you to get an options account. I know some of you are saying that you are hopeful in getting that soon. TD requires an oral exam. So sounds like different brokers have different requirements. Generally speaking, I will say most brokers just require an online application. It seems like TD offers has a little bit more of a barrier to that. So for the 22% of you that say that you do not have an options account, again, I encourage you to start that process, contact your broker, understand what you need in order to start trading options. And lastly, just a quick poll, just so also this helps us understand what information to send you after we're finished here. I just want to get a sense for what brokerage firm do you currently trade with. This also helps us follow up with you if, let's say, you've answered that you don't have an options account. We can help you understand what is the best way to go about starting your brokerage account. I'm sorry, your options account. So are you guys able to answer this poll? What brokerage firm do you trade options with? Okay, so it looks like people can't see any polls. So you know what? I'm gonna stop that, and I'm just gonna go ahead and get started here simply because we have a lot to cover. I want to make sure we get to all of it. I think that's more important, and we will follow up with you separately as far as helping you guys get access to an options account. So let's get started. First of all, what we're going to discuss here today are quite a few different things. Number one, we want to talk about what are the top 2 income option strategies. So we'll talk about cover calls and cash secured puts. And I want to talk about those 2 strategies because those are 2 strategies that are going to be really useful in helping you guys better understand how you can practically use options for your portfolio. And I specifically want to show you why your equity investments, meaning the stocks and ETFs that you currently hold in your portfolio, why they are the optimal strategies for you to implement a cover call or cash secured put. So for those of you that are saying that you're brand new to options trading, that's okay, because this doesn't require you to know anything about options trading. For almost the 95% of you that answer that you trade stocks or ETFs in some fashion, that's all you need to know in order to learn something today on our beginners options master course. So once we understand why equity investments provide us the opportunity to generate income utilizing options, then we'll talk a little bit about how can you use these income strategies, and what are the optimal income strategies to go about doing so. And then I'm going to show you some of the weekly reports that we generate to help you do this. But more importantly, we want to show you how you can automate everything that I've just taught you here using OptionsPlay. So this is going to be part 1 of our beginners master course for April. We're doing part 2 on April 14th, adding leverage using options next week. And I hope that those of you that will be joining us for our virtual options education day on April 27th, this is going to be a half-day intensive course. We're going to take a lot of the things that we're teaching you here today, and we have invited multiple speakers. We have 5 speakers on deck that day, where we're going to do it during business hours from 11:30 at noon to 4 p.m. at the close. And we're going to be doing live trading, me and 4 other speakers, where we're going to each cover a different strategy, and we're going to show you how to implement them in the live markets when the markets are still open. And during that time, we'll allow you to ask questions and provide your inputs so that you have an interactive learning experience from professionals as to how we actually implement these strategies in our portfolio. So I'm really looking forward to having everyone attend that virtual options education day on April 27th. But like I said, I have a lot to cover here today, so let's go ahead and get started. Now, most options education with respect to income strategies usually starts with the cover call. But the reason that I don't start with the cover call is because the cover call assumes that you already own some stocks. But stocks don't just magically appear in our portfolio. We have to acquire those stocks. We have to buy those stocks. So that's why I want to start with a short put, because a short put is actually a strategy that allows you to acquire some stocks and ETFs in your portfolio at a discount. Usually that discount factor is somewhere in the 0.5% to 1% discount on a stock purchase. So before we even talk about the strategy, just ask yourself, how would your portfolio improve if every single stock purchase you purchased was at a 0.5% to 1% discount? So instead of paying $100 for that stock, you pay $99 for that stock. It may not be such a big difference, but in the long run, that might make a considerable change to the rate of return of your portfolio. And the reason that a short put allows you to buy a stock at a discount is because a short put is very similar to a limit order that obligates you to buy a stock. So when you sell a put, what it does is it obligates you to buy the stock at the strike price, which is the price that you want to purchase the stock at upon expiration. Just like a limit order obligates you to buy a stock at a certain price that you place your limit order at. The difference between a short put and a limit order is that a short put will deliver 100 shares for every contract that you sell. A limit order you can place for any number of shares. A short put you must trade in 100 share increments. Now, the difference between selling a put and buying placing a limit order is the fact that when you sell a put, you get paid income to sell that put. So you have the same obligation as a limit order, but you get paid an income. And to sell that put, you need cash or margin in order to sell the put. The same type of requirement that you need to place a limit order, because if you place a limit order to buy 100 shares of a stock that's trading at $50, you would need $5,000 in your account to place that limit order. Same thing here. When you sell a put option for $50, you're going to have to put up the same $5,000 minus some income. Now, let's say you have a $100 stock, and you place a limit order at, let's say, $95, you can place that limit order, or you can sell a put option at $95 because you want to buy the stock at a lower price. So when you sell a put option, just like a limit order, there are 2 possible outcomes. The stock at expiration can either be above your strike price, in this particular case above 95, or it can be below your strike price, below 95. If the stock is above 95, think about what happens with a limit order if the stock never hits your limit price. nothing happens, right? In the same thing with when you sell a put, if it doesn't go below your strike price, nothing happens. But you keep the income that you receive from selling that put option. And you can choose after the put expires whether or not you want to place another put option. Just like you have a limit order that expires at some point, once it expires, you can decide, do you want to place that limit order again? Again, the difference between a limit order and a short put is that a put option pays you income. So even if the stock doesn't go below your strike price, you can rinse and repeat this strategy for additional income if you still want to purchase the stock at some price in the future after the put options expire. If the stock does go below your strike price, now you own the stock. The only difference here is that you own the stock at the strike price, which is $95, minus the income that you receive. So if, let's say, you collected $1 income on selling that put option, now you own the stock at $94 as opposed to $95. As a limit order buyer, you would own the stock at $95. The difference here is with the short put, you have a small discount factor. So that's the first step in enhancing your equity positions, is buying all the stocks and ETFs that you want to acquire, but doing so at a discount. And short puts allow you to do that. And I want to show you some more examples today of how you can utilize this strategy. But before I move on, I just want to quickly make sure everyone understands why you might want to buy your stocks using a short put. If that makes sense to you, please type 1 into the chat window on your screen. Okay, perfect. I see a lot of ones. Great. So let's say you use short puts or you place a limit order, however you acquire your shares, and you actually acquired this stock, whether at $95 with the limit order or $94 with the short put. Now that you own your stock, now we can take a look at selling a cover call. Now, most of you, if you've learned about options trading, if you've traded options, you've probably have heard of this concept or this term called a cover call. So let's talk about what a cover call actually is. So this is a strategy. I think the best way to think about cover calls is not as an income generating strategy, which is what you'll learn in most places. I think of cover calls as a way to take profit on the stocks that you own when they rally significantly. Think about why you own a stock. You own a stock because you believe it's going to increase in value. But that is only useful to you if you are able to take profit. Because if a stock increases in value and then comes right back down to where you were, you have a flat position. You don't make any money, you don't lose any money. So it's important that when you buy a stock, that at some point you find ways to take profit on that stock when it rallies, so that if the stock does decline later, that you don't give up those gains. So an important part of investing in stocks or ETFs is being able to take profit when the stock rallies significantly. That rally could come out of nowhere. Many times it does. Many times good news comes out, or an earnings comes up. Whatever the reason is, sometimes you get this very large shift in momentum, and you want to be able to take profit on that. And cover calls or limit orders allow you to do that, right? Placing an order at a high price, and when the stock rallies, allows you to take profit. And that's really something that you should want to do on many of your equity and ETF investments. And cover calls is a way to go about doing so. But when you sell a cover call, there's also a secondary benefit of not just taking profits on your stocks, but it pays you some income. So think about the stocks that you own. It might take a while for that stock to rally, right? Maybe this month it goes up, next month it goes down, 6 months later the stock makes that significant rally. And during that time, you wait for that stock to rally. If you just place a limit order, or if you're just sitting there and waiting, the only thing you might be getting paid during that time is a dividend. But when you sell a cover call, you can generate an income stream month to month. Every single month this goes on before. The first month it goes up by a few percentage points, the next month it goes down by a few percentage points, and the third month it rallies significantly. During those 3 months, you could have generated some income. So this is really why we want to show you how you can use a cover call to place an order at the target price that you have on an existing stock position that allows you to take profit on it when the stock rallies significantly. Because when you sell a cover call, it obligates you to sell your stock at a stock at the strike price upon expiration. That strike price, let's say you have, in this particular case, in the previous example, we said we have a $95 stock that we purchased. Maybe your target on this particular price on the stock is maybe 110. So you have a target price of 110. You sell your cover call at 110, and this requires you to own at least 100 shares of each stock in order to sell a cover call. So this strategy is useful on any strategy, on any position that you have at least 100 shares of. Now, just like the short put, when you sell a cover call, you have two possible outcomes. The stock can either be above your strike price, which in this particular case is 110, or it could be below your strike price if it's below 110. So just like a limit order, if you have a $95 stock and you have a limit order at 110, chances are the stock's not going to reach that amount in the next few days, right? So you place a limit order, it might go up a little, it might go down a little, and then, you know, maybe a few months later, the stock rallies, right? But during that time, you're basically waiting. And each month that you sell a cover call, you can rinse and repeat for additional income. So you can sell cover calls multiple times, time after time, for what we consider an additional income stream while you wait for that stock to rally. And once that stock makes it above that strike price, now what you've done is you've sold your stock at the strike price, which is the price that you wanted to get out of your stock at, plus the income that you receive. So you're going to not only be able to take profit, but you're going to be able to generate an income stream waiting for your stocks to rally up to the point that you are comfortable taking profit on. So that's, in my opinion, the best way to think about a cover call. So far we've talked about selling a call option, a put option in the first slide, and now we've talked about selling a call option. So for those of you that joined us on our last course, we covered a short put and a short call. But we talked about it more from a speculative nature in terms of what happens if you sold a call, what happens if you sold a put. This is a more practical approach of something you can actually do with those two strategies on your stock portfolio. And it really requires no additional knowledge of options trading, just a desire to improve your stock and ETF investments. So that is why you might want to consider using a cover call on your stock portfolio. So does that make sense, everyone? Please type 2 into the chat window as to why you might want to sell a cover call on the stock positions that you own. Okay, great. So I'm actually going to skip these two slides because these are fictitious examples of a short put and a fictitious example of a cover call. What I'd prefer to do today is actually go through some real examples, okay? So I'm going to skip over to those two fake examples because in a few minutes, I'm going to show you some real examples using stocks that you probably own in your portfolio that I think probably means a little bit more to you than some of these fake examples. So what we're going to do right now is we're actually going to jump into, now that we understand the mechanics of a short put and we understand the mechanics of a cover call, now I want to talk a little bit about how do you actually go about selecting which call to sell and which put to sell. You know, what expiration date do you use? What strike price do you use? Anyone who's ever traded options has used the options chains, right? So how many of you have used an options chain? Please type yes into the chat window. And for those of you that are brand new to options trading, I'll show you what an options chain looks like. It's not a particularly fun user experience, right? So this, for those of you that are brand new to options trading, I'm just pulling up an options chain so that you can see what I'm referring to. Let's see, let's do something like Canadian Pacific Railway. Here's an options chain. As you can see, here are the April options. As you can see here, we have our calls on the left, right here, and puts on the right. And you have a lot of different numbers here, right? So you have an expiration date, you have your strike prices, and you have to choose one of these calls or puts to sell, right? So even though you understand the concept of selling a put and the concept of selling a call, there's still a lot of things that you need to search through these types of pages to decide where do you want to sell. So what I want to do is first give you an understanding as to how do you go about selecting an expiration date and strike price for a cover call. So for both cover calls and short puts, as far as selecting an expiration date, it's actually the same method. So as you can see here, I have April, I have May, I have July. There are a lot of different choices. So what I have here are choices that range from short term to long term. And what you're going to notice is that when you sell a put option or a call option, when you choose from these short dated options, you're going to get less income. And the reason for this is because you have a lot more certainty as to what's going to happen between now and the expiration date. So if I sell an April expiration date, there's a fair amount of visibility for me as to what's going to happen between now and April, right? We know that we're in this, we're heading into a recession. We know that it's unlikely that the coronavirus is going to drastically change momentum in the next couple of weeks. So we have a lot more certainty as to what is going to happen between now and the expiration date in a few weeks from now. But if I go out to July or if I go out to September, there's a lot less certainty as to what's going to happen. How quickly is the coronavirus going to shift its momentum? How quickly is the market's going to get back on its feet? So for that, what I'm going to receive is more income, but a lot less certainty. So many investors will say, well, if I'm seeking income, then I think I'm going to move towards something longer term because I'm going to get more income, right? So I obviously want to generate the most amount of income. But this is really where I think options trading can be quite counterintuitive. And I would say everything about selecting expiration dates and strike prices is very counterintuitive, because we back tested these strategies and we said, if we sold short dated options more frequently, does that add up to, the same amount of premium as longer dated options that have less frequency, right? Because I'm going to get more income. So what we did is we did a lot of research, and based on our research, we saw that the shorter dated options actually generate more yield for you in the long run. And this is for a couple of reasons. Number one, we discovered that when you're selling options, when you're selling puts, when you're selling cover calls, you generally want to avoid selling going into an earnings event. So because earnings event creates these large shocks against large volatility events that usually is negatively affects a short options position. So we generally tell users to avoid selling cover calls, short puts, and many other selling strategies going into earnings. So when you sell short dated calls, when you sell a 1 month call, you can sell 12 calls a year. And we know that there are 4 earnings announcements a year, which means that 25% of the calls that you sell, we can avoid, but still get coverage the other 75% of the year. When we sell 3 month calls, we can only do that 4 times a year, which means that every single call that we sell, or every single put that we sell, has this large uncertainty factor built into it. So it's really hard to avoid selling going into earnings. So basically, you can't avoid earnings when you sell longer dated options. So that's the first reason why you want to skew towards the shorter end. But the more important reason is because the premium that you receive by going out longer term, when you go out longer term, the premium that you receive is not linear to time. Meaning, if I sell a 1 month call, let's say I collect $1 for that 1 month call. If instead I sold a 3 month call in that same stock, I'm not going to get $3 for it. I'm roughly only going to get roughly $2 for it, which means that if I sold 1 month calls, I can actually sell 3 months and collect $3 over the 3 months versus only $2 over the 3 months when I sold the 2 month call. And that means I can even avoid the month where there's an earnings coming up and collect the same amount of premium without the risk of taking on when earnings is coming up. So these are all the reasons that whenever you're selling options, and you don't necessarily have to sort short-term options, it's just that when you're using a page that looks like this, and you're trying to decide, should I trade April or May or July? You should always move towards the shorter end of the spectrum, because it's going to allow you to trade more frequently, which will actually add up to more premium for you at the end of the year than if you do longer dated options, which on paper look like they have more income, but in the long run, it's actually going to reduce the amount of income you receive from that strategy. So I want to make sure that that makes sense to everyone before I move on. Why it makes sense to sell shorter dated options, please type 3 into the chat window if selling short dated options more frequently makes sense to you as to why that adds up to more income for you at the end of the year. Okay, perfect. I see lots of 3s. So now let's take a look at strike prices, right? So now that we've understood how do we go about selecting expiration dates, within each expiration date, there are lots of strike prices. So let's say we decide for this particular stock, we're going to sell the April expiration date. But as you can see here for April, there are strike prices going from 250 all the way to 375. And the stock in this particular case is trading about 314, right? So the at the monies are about right here. So the question is, if you sold the put option, where do you want to choose? Do you want to choose 315, 300, 270, 335, 350? What option do you want to choose on a strike price? So let's just use this stock for an example. Let's say we have $314, $315 stock, right? So I'm going to use this as an example for us to do this particular exercise. So our stock is trading at 315. So think about a limit order, right? Forget an options trade. If a stock's trading at 315 and you want to place a limit order to buy the stock, where could you place that limit order? You'd place it below the stock price, right? That's the same way that you'd select a short put strike as a price below the stock price that you want to buy the stock at. So depending on the user, some people might choose maybe a 310 strike put a limit order, just $5 below the current price. Some people might choose maybe 300, something a little lower. And some people might choose something really low, maybe a 290. Right? Now, obviously, the lower you go, the less probability of your order being executed, right? Because the stock has to move to that price or lower in order for your trade to execute, just like a limit order, right? So if you place your order at 310, I'd say you have a pretty good chance of maybe getting executed in the next day or two. At 300, maybe in the next week. 290 probably might take a while for that order to get executed. So what I have here are three types of strike prices. We have an aggressive strike price. So I would consider this I would consider this one the aggressive strike price. I would consider this one maybe the optimal, and this one maybe the conservative strike price, okay? So an aggressive strike price are much higher strike prices. They require the stock to have a much smaller dip before the trade is executed. And in exchange for that, you're going to get a higher premium or higher income on that short put. If a 290 call, these are much lower strikes. These require the stock to make a much bigger dip before these trades are executed. And in exchange, you're going to get less income. So the question becomes, which strike price should you choose if you are selling a put option? And I'm curious if anyone wants to venture a guess. You can type into the chat window A, O, or C, which one you think you would choose if you were selling a put option. A for aggressive, O for optimal, or C for conservative. See a lot of O's, see a few A's, but a lot of O's. So, and this also I think is one of the more counterintuitive parts about options trading, is that we've back tested this. The answer is the aggressive one. The aggressive one. And the reason for this is because think about why you're selling a put option. You're selling a put option because you want to own the stock. So what should you do? Number one, you should prioritize a high probability of acquiring these shares. So generally speaking, what you want to do is you want to pick strike prices that are relatively close to the current price that give you a high probability of owning that stock, so that if the stock does rally in the future, you participate in it. If you choose something that's relatively low, you have a much smaller probability of participating in any upside because you don't own the stock. So if you choose something like 290 down here, you have very little chance of participating in any upside gains because you don't own the stock. Second reason that you want to choose a more aggressive strike price is because you get a higher income, which equates to a larger discount on your stock purchase. So it's kind of a win-win here, why you want to choose strike prices very close to the current price, because you want to participate in upside. That's why you're selling the put option to begin with. And you want, the reason that you're shorting a put instead of placing a limit order is because you want to maximize the discount factor that you're getting. So for those reasons, when you're selling a put option, you want to choose strike prices relatively close to the current price. So when you sell, and many times people will say, well, how do you choose 310, 300, 290? We usually take a probability-based approach. So we always use, let's say, a 40 delta put option, and that's a put option that has a 60% chance that it's going to expire worthless. Something here, down here, probably has about an 80% chance that it's going to expire worthless. So you only have roughly about a 20% chance of owning the stock when you sell something that low. And you generally don't want something that low when it comes to your probability of owning the stock. Here, your probability of owning the stock is 40%. You know, those are the types of odds that you want to look for when you're selling a put option. So I want to make sure that makes sense to everyone. So please type 4 into the chat window if that makes sense to you. So we usually don't like to use a percentage. You know, there was a question is using percentage. And the reason that we don't use percentage is because different stocks have different volatilities. And if you use a rule like 5%, that might work really well when you're using Canadian banks, but that does not work very well if you're trading some of the marijuana stocks, because some of the marijuana stocks move 5% a day, the banking stocks move 5% a month. So you don't want to use something like percentage. You always want to use a probability-based approach because a delta adjusts for the volatility. So if, let's say, this stock is much more volatile, it'll naturally adjust this 310 strike down to maybe a 300 because it's a very volatile stock, versus 310 for a less volatile stock. So it'll automatically adjust that for you. You don't have to use a percentage. And that's why, generally speaking, I have tried to avoid using the percentages. Now let's take a look at a cover call, right? So now that, let's say we own this stock. Let's say we own this stock in this particular case from, let's say we own it at 310, right? Let's say we shorted the put, and let's say we collected $5 on that put. So we actually own it at 305. So now we own this Canadian Pacific Railway. We think it's going to rally somewhere in the future, right? And maybe you might place a limit order to sell the stock. Maybe you might place it at 310. Whoops. Maybe you place it at 310, maybe 320, or maybe 330. So this equates to the aggressive strike price. This equates to the optimal strike price, and this equates to the conservative strike price. So the conservative strike price requires the stock to rally much higher. These are your higher strikes. This gives your stock a lot more upside before you sell it. In exchange for that, you're going to get less income. The more aggressive strikes, in this particular case, the 310 strikes, these are much lower strikes. They give your stock a lot less upside, and you're going to get much higher amounts of income for it. So the question becomes, when you're selling covered calls, where do you want to sell your calls? So same thing, A, O, or C. Which one do you think it is in the chat window? Type it into the chat window, A, O, or C when you're selling a cover call. I see a lot of, okay, this time it seems like it's pretty much all around the place. I would say a lot of A's, a lot of aggressive, a lot of O's, a few C's. So we also back tested this, and the answer was very clear to us. It's actually the, it's actually the conservative strikes. So sorry, I'm gonna quickly draw this again. I accidentally deleted it. So we said the 310s, 320s, and 330s, right? Now, our backtesting shows that you want to focus more on the 330s, the conservative strike price. And the reason for this is because many times, we tend to find investors tend to go for the more aggressive strikes. And the reason for it is because the more aggressive strikes give you higher amounts of income. But this is why in the first slide, when I talked about cover calls, I said, don't think of cover calls as an income generating strategy, because if you think about it as an income generating strategy, what you forget is the fact that you are taking on $305 a share of risk just to make some income. No, you're taking on $305 worth of risk because you think the stock is going to move higher. And the only way you're going to be compensated for that risk is if you actually allow the stocks to rally before you take profit. So yes, the 310 strikes will generate more income than the 330 strikes, but what you're giving up for it is $20 worth of potential upside. And guess what? When you choose the 310 strike, are you going to get $20 more in income? The answer is no. In this particular case, let's say you sold the 310s, maybe you get, in this particular case, maybe you get $10 in income, and maybe in the 330s, maybe you get $2 in income, and you say to yourself, well, I certainly want $10 in income instead of $2 in income, but you forget that you're giving up $20 in upside for an additional $8 in income. And that might make sense the first couple of months, but in the long run, that does not work out. And our backtesting clearly shows that the higher amounts of income that you receive for the more aggressive strikes do not, in the long run, offset what you give up in the underlying stock. So that's why I, in the first slide, told that when you're thinking about cover calls, think of it as a strategy that allows you to get out of the trades that you own when they rally significantly, and think of the income that you get as a secondary nice to have while you wait for the stocks to rally. Because then you're going to be thinking about, well, how much upside do I really want on the stock? Well, where do I think I want to take profit on the stock? That should be your first priority. And if you think about that, your answer will always be a higher strike, even though it pays a significantly smaller amount of income. So if you, and this is again, one of the very counterintuitive parts about trading options, because when you look at that option chain, you're going to say to yourself, well, if I'm going to sell an April cover call and the stock's currently trading at 315, right? This is where the current stock is. Well, if I sold that 320 call, how much am I getting in this particular case? 320 call, I'm getting somewhere between 630 and 955. So let's call it maybe $8, a little 780 or so, that I'm getting by selling the 320s. The 335s, I'm getting maybe $2, right? But guess what? Here I'm giving up $15 in upside from 320 to 335. I'm giving up $15 in upside for an additional roughly, let's just call it $5. So you're giving up 15 in additional for $5 in income. Guess what? In the long run, that doesn't make up for the $15 in upside that you're giving. So don't look at the income that you receive on a cover call. Think about, well, if I own the stock at 315, where do I want to get out where I'm comfortable taking on the risk of continue holding on to the stock? Because for continuing to hold on to the stock, what's your risk? Your risk is that this stock declines heavily to the downside, right? As we've all seen over the last couple of weeks. You take on a substantial amount of risk to continue holding on to that stock. So you better be compensated for when it does rally to the upside. You don't want to get taken out $2 or $5 into your rally. When it extends that rally many times, it can go 20, 30 bucks. So that's why when you're choosing your cover calls, choose conservative strike prices, because you're going to be hitting yourself over the head when you give up $15 in income in exchange for just an extra $15 in upside in exchange for just $5 in income. So I want to make sure that makes sense to everyone. So please type 5 into the chat window why when you're selling cover call strikes, you want to choose strike prices that are far away from the current price. Perfect. Okay, so just a quick summary before we jump over to OptionsPlay. Number 1, you want to sell put options to generate a discount on the purchase of your stocks. You want to start selling cover calls immediately after you acquire those stocks. You don't want to sell cover calls after you've taken on a huge hit. I've seen a lot of stocks, someone buys a stock at $100, the stock takes a huge dip, it's now trading, let's say, at 50, and I get a question from a user saying, should I start selling cover calls now? The answer is you can, but what you're doing is you're never going to be able to get any premium for that $100 call. So guess what? You're selling maybe a $60 call, $65 call. And what happens if the stock does make that big rally up to 65? Now you've locked in a loss. A lot of people don't want to lock in losses. So when you're selling covered calls, don't wait till you're down 50% on a stock before you think about selling cover calls. Start selling cover calls immediately once you start owning that stock. When you're selling any options, short-dated options will allow you to maximize that time decay. So if you're thinking about between the Aprils or the Mays, always choose a shorter-dated option. When you're choosing strike prices, short puts, always choose strike prices near the stock price. When you're selling cover calls, further away from the stock price. Again, very counterintuitive, but a lot of things about choosing expiration dates and strike prices, in my opinion, are quite counterintuitive. And lastly, you want to avoid selling options going into earnings. So those are the tips that you might want to take away from today if you're thinking about using any of these strategies. So with that, what I want to do is I want to show you OptionsPlay. This is the tool that everyone has access to completely free of charge as part of the partnership that we have with the Montreal Exchange. And the tool itself is really designed from the ground up to help avoid having to spend too much time on the options chain, because we find the option chains difficult to navigate for the best at times, and many times for experienced traders, we find that after we spend some time on the option chains, we still have to apply it on some type of calculator to generate our risk and potential rewards. So we really created OptionsPlay to make the security selection process as easy as possible and provide you with all the metrics that you need to analyze a trade and decide whether you want to place a trade without having to use the option chains. So today, what we're going to focus our attention on is the income tab, because this is an income-focused webinar. And what this tool is designed to do is allow you to create a watch list of all the stocks that you follow. And you can utilize a watch list for either the stocks that you want to purchase or the stocks that you own in your portfolio. And the income tab will actually automatically select the cover call for you, both the expiration date and strike price, or the short put for you if you're trying to acquire the shares. And it will not only select the expiration date and strike price for you, it'll give you all the metrics that you need to decide whether it's a trade for you. So let's look at Enbridge. Enbridge is currently trading at $44. Let's say I want to buy this stock, right? We always start off with buying the stock. So in this particular case, you can use the income settings button to select what your time frame that you prefer for cover calls. So I choose short term, and risk tolerance you can choose from conservative, optimal, or aggressive. And for short puts, you can also do the same thing. You can choose your own time frame. You can choose conservative, optimal, or aggressive. Now, like I said, we have our preferred settings that we teach. You can override those for those of you that have some experience, and there are various reasons that you when and why you might make modifications to these settings. But for the most part, for those of you that are brand new, for those of you that are starting out, the settings that we laid out today are the ones that we generally suggest that you start off with. And this is designed so that you never have to pull up an option chain. You just simply type in the symbol that you either want to acquire or the stocks that you already own in your portfolio, and we will show you what is the expiration date and strike price. So for Enbridge, which is trading at 40.5, we're telling you to sell the May 1st $38 puts. Now that $38 put will generate $112 in income. So think about this. If you were to buy 100 shares of a stock at $38, you would need $3,800 in your account to purchase 100 shares of that stock. When you sell a put option, you don't need $3,800. You only need $3,688, which reflects the $112 in income that you receive, which equates to a 2.76% discount. So volatility in this current environment is high. So what you're going to find is you're going to be able to generate a high amount of yield, which then means that you're going to generate a much larger discount factor. So 2.76 is higher than what we would normally see. And the energy market is currently trading at a higher volatility. So for these types of names, you're going to see some pretty big discount factors, 2.76%. That's a significant discount factor, because instead of paying $3,800, you're only paying $3,600, $3,688 for the stock purchase at $38. So even if the stock just ends up at 38 at expiration, your effective cost basis on that stock is $36.88, which means that you immediately have $112 realized P&L on your stock position. So this is really how you can use this tool to quickly type in any stock. Let's say you want to buy Bank of Nova Scotia and you want to sell the May 1st 52.5 puts for a $55 stock. This will generate $113 in income, which in this particular case is a 2% discount factor. So you can use this so that you can quickly type on any stock. Let's take a look at any other stocks. Let's say you want to look at Canopy Growth, right? what's interesting about these marijuana stocks is that, first of all, they're very volatile to begin with, and they're even more volatile now given the current market scenario. So if I can sell a May 1st $18 put option when the stock's trading at $20 and collect $125 on a $2,000 stock purchase. So to buy 100 shares of an $18 stock, I need $1,800. In this particular case, I only need $1,675, which reflects the $125 discount. How big of a discount is that? That's a 6% discount. That is not a small number to look at for a stock that trades so volatile or that is so volatile. And you can use this strategy for any stock that you want to purchase, as long as the stock is relatively liquid, as long as the stock is not a penny stock. So on Hexo, I don't think you'll be able to find anything just because there are no strike prices around the 99-cent mark. So generally speaking, stocks over $10 are better for this type of strategy. You might find some strategies in the $6 mark that you can do this for. So here's a Horizons ETF where you can sell a $6 put for $110. That equates to a 16% discount. Now, I don't know what HOD is. It looks like it's a Canada crude 2 times bear ETF. So not your typical ETF that you would hold on to the long term. So I don't know that I would recommend this strategy for this, but if you were, because HOD is more of a day trading symbol, but on a stock that you might want to hold long term, like maybe Canadian National Railway, which is trading at 113, you can sell a 108 put, collect $199 income on that, which is a 1.76% discount factor, allowing you to buy the stock at $108 instead of $113. So these are the types of discount factors that you can expect to see by selling put options. Vice versa, if you're looking to sell a call option on a stock that you own, let's go back to maybe some of the banks. But let's say you own BMO, very popular stock that many of you own in your portfolio. This is telling me to sell a May 15th $78 cover call. This generates $68 in income, which is 0.96% of the underlying stock price in 39 days. Now, you might be thinking to yourself, 68 bucks doesn't sound like a lot, but this annualizes out to 9% on a stock that pays a very nice 6.1% dividend yield in this current market environment. Now, it's only paying a 6% dividend because the stock has taken such a large move to the downside, but still, you're getting 6% yield on the dividend, 9% on the cover call. Your total yield comes out to be roughly 15%. That is nothing to sneeze at when it comes to an income stream on a stock that you are holding for the long run. Bank of Nova Scotia, $55 stock, selling the $60 call option, collect $64 in income. That's a yield of 10.83% on a stock that pays a 6.5% dividend. And maybe on some of the other stocks, maybe you have a lower dividend yield. Let's say on TELUS, you have a 4.4% dividend yield. TELUS in this particular case, one thing I do notice that it says $1 in income, but my guess is because the bid-ask spread here is so wide. So I wouldn't rely on this after hours quote right now unless you want to use the midpoint. So the midpoint would suggest a 50% yield, which also I don't think is a real number, because I think, again, the after hours quotes are just so wide that even this midpoint is distorted right now. I think that you would probably not be able to get filled at that particular price. But let's take a look at some other stocks. National Bank of Canada trading at $53, yielding a 5.5% yield. Selling a cover call, $60 cover call generates $39 in income, which is a 6.85% yield, also higher than the current elevated dividend premium. So these are the types of premiums that you can expect utilizing OptionsPlay to instantly help you find the starting point for expiration date and strike price, giving you the yield analysis so that you can understand, am I getting enough yield for this? And then if you're ready to trade that, go ahead and click on the trade button so that you can instantly enter this trade into your broker's platform. So this is a strategy that I highly recommend for those of you that are equity investors to make sure that you utilize and understand how you can enhance your stock and ETF positions that you are holding today and you're trading today, even if you're not trading options, and how you can utilize options to improve those results. So with that, what I want to do is I want to leave you with a few different things before we open this up for Q&A. One of the things that we started doing tracking is what symbols are very liquid in the option space, what symbols are not very liquid, so that, because we've been getting a lot of questions from users as to what symbols should you trade or what symbols are most liquid. So we published this list and we'll be sending it out with the recording after we finish here today, so that you have a running list of what is the current liquidity, what is the implied volatility, as well as when are the upcoming earnings for that underlying name. And what's an interesting metric to keep an eye out for is how big this list is, because the larger this list is, the more normality, I would say, we have achieved in getting back to a more stable market, because this list has shrunk substantially as the market sold off, meaning liquidity has dried up, and this list gets smaller and smaller as liquidity dries up. Now, when things start to stabilize and things start to get back to normal, you're going to see more and more symbols show up on this list. This is something that we just published this week, so this is a new thing that we'll be sending out to everyone. I hope that this is useful in helping you guys better understand how to utilize the options market for your trading, especially for those of you who are brand new. You see that there are 300 symbols that you can trade options on, but in reality, from my perspective, there's only a handful that I would consider very liquid and a handful at this point that I would consider somewhat liquid. Anything outside of these 38 names, liquidity is really not there. So be careful if you're trading something outside of these top 20 names, and especially if you're trading in these next 20 names, you're going to find that you might have some trouble getting orders filled. And if you go outside of this, then you might have trouble getting filled at all. And lastly, what I want to do is I want to show you some of the short put and cover call reports that we send out every single week. This is also designed to make your life a little easier. So the short put reports will basically take all of the names in the cover call, all the optionable names in Canada, and we show you which stocks have the highest discount factor on a stock purchase. So you can look at this list and see which symbols can you sell and how much of a discount factor can you receive. Now, most of these are some pretty high volatility stocks, but look at this, Air Canada. Maybe you think the Air Canada stock is near a bottom and you think it's time to maybe buy some Air Canada stock. As you can see, by selling a put option here, you're getting a 15% discount on your put option. So I would certainly look at utilizing a put option to buy some of these stocks near their bottom, especially if you're trying to catch these falling knives. I'd much rather have a 15% buffer to the downside than to place a limit order to buy at 14, because this is telling you to sell the $14 strike, but you're collecting $2.02 on the short put, which gives you a 15% buffer on the stock purchase. Weed, Canopy, you're getting a 13.7% discount factor. So if you think it's time that these marijuana stocks have bottomed, look at selling a put option to do it. But you can basically use this short put and go down the list and see, are there any stocks that I want to buy? Maybe you want to buy Sucor. Selling that $24 put option gives you an 11% discount factor. So these are some big name stocks that are providing some big discounts because volatility currently is very, very high. And this report shows you exactly which stocks give you the highest discount factor, exactly how much of a discount you get, and what strike price and what expiration date you want to sell to get that discount factor. And for stocks that you own, using the cover call report, This will give you, you can go down this list and see which stocks that you own. Maybe you look at this and you say, oh, I own this marijuana stock. I can sell a $5 cover call and generate a 6% yield in the next 39 days, which annualizes out to 74%. And that's a strike price that's 22% above the current stock price. A $5 strike price on a $4.1 stock is 20%. So the stock has to rally 20% in the next 39 days in order for the stock to be called away. Otherwise, you generate a 6% yield in 39 days. You know, that's obviously a bit of an extreme example. Let's take a look at some of the names that are more likely that many of you have in your portfolio, like maybe Sucor Energy trading at $24, telling you to sell the $29 call, which generates a 3.9% yield, and the strike price is 20% above the current price. So this is how you can use this report to very quickly find out where you can generate income to purchase the stocks that you want to buy using the short put report, and where you can generate income on the stocks that you own through the cover call report. And this is emailed out to everyone Monday morning at 10:30 a.m. You should have received it this morning. This was just updated this morning. And it provides you with all the information that you need outside of the OptionsPlay tool. So both of these resources are available to you free of charge to really allow you to implement everything that I taught you here today. So with that, I want to thank everyone for taking the time out here this afternoon. I know I covered a lot of things with you here today, but really the point of this is to give you a very comprehensive view as to how you can utilize options, especially for so many of you that are saying that you're brand new to options and you've never traded options before, and you might be a little scared to get into options, to provide a different way to think about it, because this is really for your stock positions, right? And I think that's the best way to start with options trading. Is don't think of it as for options trading. Think about your stock positions, something that you're already comfortable with, and think about placing limit orders to buy and sell your stocks and replacing those limit orders with a short put and a cover call, because selling a put option, I know, is very scary, but it's the same obligation that you're putting yourself into when you buy a stock. When you sell a put, you're just obligating yourself to buy the stock, but you're getting a discount. And when you sell a cover call, you're just obligating yourself to sell the stock at a higher price, but you're getting paid an income. So they really shouldn't be as scary once you think about them, thinking about a short put and a cover call in those terms. And then once you get through the process of using OptionsPlay, plugging in the stocks that you may want to purchase, plugging in the stocks that you own, and utilizing this tool and looking at the discount factor that you actually receive, that's how you're going to go through the learning process and get to the point where you do feel comfortable enough to pull the trigger on your first options trade. I think that short puts is the number one most underutilized option strategy that equity investors do not consider. So it would be my honor for those of you that are learning how to trade options if your first options trade is a short put trade, because you're thinking about your stock positions and not thinking about an options trade because you're just trying to buy a stock that you want to own at a lower price. I would be honored for those of you that are first-time options traders, that if your first strategy is either a cover call or a short put, because that means that I've done my job in terms of teaching you this strategy, and we've done our job in terms of providing you the tools to allow you to feel comfortable enough to execute one of these strategies in your portfolio. So thank you so much. Thank you so much for all the kind words for those of you that did place them in the last few minutes. At this point, what I'll do is I'll try to answer a few questions that people may have regarding options trading. So if you have any questions, please type them into the chat window, and I will answer any questions, or I'll answer as many questions as I have time for here today. Let's see, if I sell a put call and get the strike met before expiration, does it execute automatically at strike? So Harit, the answer is no. So one of the challenges of selling put options is that if the stock declines below your strike price and then comes back above it at expiration, that put or call will not execute. So that is one of the primary differences between a put option, an option and a limit order. So make sure that you understand the difference. Can you show quickly how to use the optimized cover call and short put list? Oh, so I think I just did that, Laurent. Considering the high volatility, i.e. expensive options, would it make sense to sell puts to collect premium instead of wanting to own the stock? Laurent, so you're going to, yes, you're going to get higher premiums, but I would not sell a put option on a stock that you don't want to own, because you always risk, I mean, that's the risk that you're taking when you're selling a put option, is you risk owning the stock. If you don't want to own the stock, don't sell the put option. That's my suggestion to you. Raymond, you're very welcome. Welcome back, Raymond. What is sell to close? Great question. So let's say I buy an option. Let's say I buy this put option. I buy this May $54 put option. And before May 15th, I want to get out, right? So I buy a put option and the stock plummets in the next couple of days and it's reached my target price, but it's still, a month before May. How do you get out? You get out by placing a to close order. So if I bought it, I have to sell it to get out, but I also have to make sure that I specify that it's a to close order, Ed. So every single order needs to specify whether it's an opening transaction or a closing transaction. So a close order is simply telling the broker that it's a to close transaction. James, if you have a question about receiving the report, please send me an email at info@optionsplay.com, and I'm happy to look into your account as to why you might not be receiving it. Ash is asking, I wrote cover calls on a stock I purchased. It fell sharply, so I rolled down. Then it went back up above the new strike price, but still below the original strike price I paid for the stock. Should I roll the cover call at a loss and let the stock get called, or let the stock get called away at a loss? So Ash, that depends on whether you believe the stock is going to continue rallying. So let me just make sure everyone else understands your question. So Ash bought a stock. Let's say he bought this $50 stock. Initially, he sold a $60 cover call, but instead of the stock rallying, right, the stock declined. And what he did is when the stock declined, he sold another call. In this particular case, maybe he sold a $48 call. Now what happens is the stock rises above 48, right? So he's asking, what should I do? Because if he doesn't do anything, he'll sell his stock at 48 that he originally purchased at 50, which means that he would take a $2 loss in this particular case. So Ash, my question for you is, do you think the stock is going to continue moving higher? If you think it's going to continue moving higher, then I would roll the cover call and maybe roll it out and maybe now sell maybe a $55 call or a $60 call. If you think that this is kind of as far as it'll go, meaning if you're concerned that maybe that going forward is just going to roll back down here, then I would let the stock get called away. So it really depends on whether you think the stock's going to continue moving higher or lower. Higher, you roll it. Lower, you let it get called away. For smaller orders, multiple 30-day expirations can really be eaten up by commissions, both on the option and the strike and the assignment in case of a short put. Your examples can seem seriously optimistic. So Gary, I certainly understand your concerns about commissions, right? So, in the examples that I showed you, we were looking at about 100, 150. Most of the examples were somewhere between $100 and $150 in commissions. And I don't know how much you're paying in commissions, but I can't imagine them being too much more than $10 a contract, meaning per ticket plus $10 plus, maybe $1 or $1.50 for a contract. If you're trading multiple contracts, then it gets significantly cheaper. If you're choosing really small price stocks, I completely understand. So that's why when I said that you want to choose shorter dated options, I didn't necessarily specify that you had to trade weekly options. I was just saying that if you have the choice between multiple expirations, in this particular case, maybe you wouldn't choose between April and May, but you might choose between May and July, that you always choose the shorter of the two options that are viable for you. So if you happen to trade at a higher cost broker and you need to overcome costs by going further out in time, I understand that. But if you have the choice between two expirations, always choose the expiration closer to the current date. What about dividends on cover calls? So you still capture the dividend because you own the stock when you sell a cover call. So that doesn't change. Is there a recording? Yes, all of these are recorded and we'll send you the recording after we finish here today. So we have to wait till expire or manually execute. So I'm not sure. I don't have the context on that, Parit. So if you can explain that, I'm happy to answer that. What happens to dividends before expiration? Are we obligated to pay? So you're not obligated to pay anything on a short put. You actually, in theory, receive the dividend as the put seller, because the person who bought the put is the person who actually pays effectively the dividend to the put seller. So no, none of these cases would you be obligated to pay the dividend. Hi, in the Enbridge example, if the income tab showing the sell cover call expires May 15th when the earnings date is May 8th, should we skip that date? Oh, yes. So I didn't see that Enbridge had a upcoming earnings date, but good call. So this is coming up on May 8th. So I would not sell the May 15th cover call. I may sell the May 1st short put. And maybe you might want to modify this May 15th to maybe a May 1st to avoid that cover call, cover call. However, the May 1st expiration, as you can see, has very limited strikes at the moment. So really nothing to do here on May 1st for a cover call. Where do I find the weekly options info? This options cover call report can be found in a couple of places. First of all, you can go to the Montreal Exchange. It's actually right here on the Montreal Exchange's website. Weekly income strategy reports. You can find that there. You can find it. We email it to everyone every Monday morning. If you're signed up for the TMX version of OptionsPlay, you get it free of charge every single Monday morning. Suppose a short put bought in January and February went bad because market dropped and you are now underwater on the options. So besides rolling it, what else can you do? There's really not much you can do other than roll it. The only thing I would say is that if you're near expiration, you want to roll it. If you still have time to go, you'd want to wait. So let's say you have sold a May, or let's say you sold a June option or a July option, hold it till you get closer to expiration, because first of all, you have the opportunity for the stock to rally back towards your strike price, and you're going to be able to collect time decay during that time. Because if you roll it now, you lose that time decay. Is there an ideal level of volatility for selling options? No, there is not an ideal level of volatility. You can always sell options, just understand that when volatility is very low, you have a smaller probability of making money from a volatility perspective, but there isn't an ideal level of volatility for selling options. I understand that short puts are not allowed in registered accounts. Is there a way around this, such as spreads? If I'm not mistaken, I don't believe spreads are allowed in registered accounts, but that's a question for your broker. I unfortunately do not know what spreads your broker may or may not allow in a registered account. What happens if I have a cover call and I sell my stock position? Then you have to buy back the call option. Unless you have the ability to sell naked call options, which I would imagine that many of you don't. And even if you did, I wouldn't recommend having a naked call option on a stock that you no longer own. So if you sell the stock, buy back the call. Can you explain rolling over a call? I thought if you sold the call at say 48, you'd have it left. You would have to let it be called away. No, any call prior to expiration, you can close. You just have to do it before expiration. You can do it a day before expiration. You can do it 10 days before expiration. You can close a trade at any time. You just have to place a to-close order. You have no obligations to let something be called away or to hold something to expiration. Do we still collect the dividend with our cover call position? Yes, you still do, because you own the stock. How many days before or after earnings season do you sell a call? You can do it immediately after, in my opinion, Kaz. Jan is asking, hi Tony, can I get a PDF file of this presentation? Yes, I will send both the slides as well as the recording. Within the OptionsPlay platform, can you submit your options order? So currently we cannot at this point submit your order for you. You have to enter your order into your brokerage account by clicking on the trade button and copying and pasting that information into your brokerage platform. How do you see the market will perform in the next 3 months? So I think today's optimism is interesting. But if you think about it, nothing fundamentally changed between Friday and today, other than 1 day of potential decline in deaths, which I think 1 day is too early to call a trend. If we see a full week of it, I certainly would say that, you know, things are maybe looking a little better. But as of right now, the economic numbers, the estimates that we're looking at in terms of corporate profits do not look particularly strong. I think the markets are going to retest their lows and be more of a range bound. I don't see a strong case for another panic sell-off. Markets certainly have stabilized substantially, considering the first after the first sell-off between the monetary and fiscal policy that global governments have stepped in with. So again, due to that, I don't see another wave of panic selling, but I do think every single rally that we get here is going to be met with a wave of selling from clients that are stuck above, that are trying to get out of their losing positions. So with that, I want to thank everyone for taking the time out here this afternoon. I know I went over a lot of things, and I know I didn't get a chance to answer all of your questions, but I really tried to answer as many as I possibly could. But what I will do is I will send everyone the recording after we're finished here today. You'll get the recording, you'll get the slides, as well as a link as how to access these optimal cover call and short put reports. And we will see you guys here next week, where we're going to be talking about how to speculate using options. We're going to talk about buying and buying calls and puts, and how you can utilize them to leverage a directional view that you have in the underlying markets, and do so in a way with limited risk. So I'm really looking forward to going over that topic with you guys next week. So I hope you guys are staying safe, and I wish you guys a great week, and I'll see you next week. Have a great evening.